Welcome to Lecture 3 on Risk Management and Insurance. In this lecture, we consider financial instruments. Those instruments include bonds, bills, shares, and other securities. Let's begin with the bond. A bond is a credit contract. So there is a borrower, there is a lender, and the borrower receives money from the lender and in return pays interest to the lender. And when the bond expires, then the borrower also has to return the initial amount of borrowed. That's a so-called principal. Now the principal is also called face value or nominal value of the bond. Interest rates can be annual or semi-annual. In most countries, interest rates are annual on bonds, but in the United States, actually semi-annual is also very popular. Now, bonds used to be embodied by certificates, by pieces of paper, but today they are just electronically recorded. Now here you see the bond, a historical bond of the Panama Canal Company, which was issued by the Panama Canal Company. This bond is still a certificate, it's still a piece of paper. Now the Panama Canal Company tried to build the Panama Canal in the 1860s. And for this it required money. So it issued those bonds. The face value of this bond is 500 francs, 500 francs. And the interest rate is 3%. So each year, the Panama Canal Company paid to the investor 15 francs, so it's 3% out of the 500. Now, the Panama Canal Company was obliged to make this payment. This bond is a credit contract, and if it does not make those payments, then the company is broke. So in French, okay, a bond is actually called an obligation because it's an obligation, okay, to make those payments. It is a credit contract, obligation. So each year, the holder of the bond, the person who bought the bond, cut off one of those coupons and handed them in with the Panama Canal Company and got the $15. Now, the coupon may not have been handed in directly. Maybe the holder of the bond gave the coupon first to a bank, and then the bank passed it on to the Panama Canal Company. Okay, so this made it easier for the holder of the bond. Now, the question is, why are those coupons still attached to this bond? Why have they not been used? Why have they not been handed in? Yeah, the Panama Canal Company, it went broke. The French Panama Company went broke. It tried to build the Panama Canal, but then almost all its workers died from the tropical diseases. And so they gave up and they went broke. Then 20 years later, in the 1880s, 90s, the Americans took over, and then they really succeeded. The Americans really succeeded in building the Panama Canal. In the 1890s, so 20 years later, okay, the Americans were better able to manage those tropical diseases, and so the loss of life than actually was less than what the Panama Canal Company, the French company, suffered. So the Panama Canal, and in the end, belonged to the Americans, and until they gave it back to Panama, okay, about 100 years later. So today, actually, the Panama Canal is run by the country Panama. So the coupons of this bond provide for 3% interest. The face value of the bond is 500 francs. So the annual interest payment is 15 francs. And the 3% is still called, even now it's called the coupon rate, because actually that when you handed in those coupons, okay, then you got the 3%. So the coupon rate is actually a fixed interest rate which the bond pays. Today, the bonds are no longer pieces of paper, they are no longer certificates, they're just electronically recorded, but we still speak about the coupon rate of a bond. When you read a financial textbook, okay, they call it the coupon rate, because historically, okay, people used those coupons to get the interest. Now, bonds have different maturities. 10-year bonds are very popular, but also 20, 30-year bonds exist. So a 10-year bond expires after 10 years. It pays interest for 10 years and then the bond expires. Now a note is also just a bond, basically. It's also a credit contract, but it's shorter term. It pays interest for 3 years and then it expires. A bill is even shorter term. Also, a bill you could actually call a bond. It's just a credit contract. A bill maybe for 90 days. 90-day bills are very popular. There's a bit of a difference with the bills. Bills do not have a coupon rate, because they never actually. You see, the coupons are annual, semi-annual. Now, if the bill is only for 90 days, okay, so then it would be too bothersome to attach coupons. So bills actually never pay the coupon rate. What's going on with bills is actually they are issued at a discount. And then later they are paid back to the lender at the full value, at the full face value. And so the lender then makes the money, okay, and gets interest this way. Let's make an example. So I have here the time axis. At time 0, the bill is issued. A year later, maybe after 90 days, the bill then is actually expires. Now the bill has a face value, let's assume, of $100. And it's issued at $98. So you see the investor who buys this bill at 98 in the end gets 100 back, and so the investor actually earns $2 of interest, okay, on this investment of $98. So $2 of interest earned here, which amounts, actually, if you express it in percent, it's a bit more than 2%. It's 2.04%. So that's because the investment is only 98. You get $2 on 98. So actually, if you calculate it, the interest payment really will be 2.04% for those 90 days. And then to be able to compare this interest payment with other investment, you should convert this into an annual rate, so multiply by 4. So in annual terms, the interest rate is about 8.16%. In finance, we always express returns in annual terms. And so we really actually can compare returns from different investments. So a bill does not involve a coupon. Instead, it's issued at a discount. It's issued below par. So that's why we call a bill also a discount bond, or maybe a zero coupon bond. Now I have to get rid of this annotation here, because it shows up in all future slides if I keep it here. So let's get rid of this. Okay, it's gone. So we have the bills, we have the notes, we have the bonds. Now, we also have the consoles. A consoles has no expiration date. So particularly the French government issued sometimes consoles. So they just issue those bonds and they pay interest on it forever. There is no expiration date. Now I have here an example of a console that still pays interest. It has been issued by the Dutch Water Authority in 1648, and it just pays interest. The bond is now owned by Yale University. It's called a console. That's how this console actually looks from 1648. Still paying interest. Yale University earns here a bit of interest. Now this bond is naturally now, or this console is naturally now a collector's item. So it's very valuable. Now, if the Dutch Water Authority really no longer wants to pay interest, what it could do, it could go to Yale University and say, okay, they would like to pay back the bonds, they would like to buy it back. But that's not worthwhile to do because it's a collector's item, it's much too expensive. So it's actually cheaper for the Dutch Water Authority to continue to make the interest payments. But another console, maybe that's issued by the French government, if the French government naturally can go into the market and buy them back and then destroy them. There is no formal expiry date, but anytime naturally the government can buy back those bonds at the market prices. Here with this bond, which has become a collector items, it's just not worthwhile to do. It's cheaper, okay, for the Dutch to continue to pay interest. Now let's discuss some interest rates. First, we look at the interbank rate. Now that's a rate which is established in the interbank credit market. So that's a credit market between the banks. So if one bank needs cash, it can go to another bank and borrow money from this other bank. Now, so that's a very, very important credit market, actually, this interbank credit market. It's a private credit market between the banks. Now, the loans here are very short term. They are just for one day. So they're overnight. So one bank borrows cash from another bank for 24 hours, from one day to the next. Very short-term credit market. Now, the interest rate payable in this market in South Africa, it's called the South African benchmark overnight rate, the SABOR. In Australia, it's called the cash rate. In London, it's still called the LIBOR, but they are now changing the system, and then it will have a new name. In America, it's called the federal funds rate. Even if it's called the federal funds rate in the United States, it actually has nothing to do with the federal government. It's a private credit market between the banks for one-day loans. Now, the interest rate for those one-day loans are naturally very, very small. But then again, you have to transform them into an annual rate. So you are able to compare it with other investments. We always actually, in the end, express interest rates in annual terms. But naturally, for a one-day loan, a bank, the lender will only receive a very small interest payment. Now, other interest rates in the private credit markets are the treasury bill, note, bonds rates. Those are also just a credit market. Those interest rates are established in the private credit market, even if the treasury actually issues those bonds or notes. So then we have commercial bill rates, maybe a 90-day commercial bill, which is issued by a large corporation. If a large corporation needs cash for maybe 90 days, they can issue bills. Or if they need the money longer term, then they can issue bonds. Now, bankers' acceptances are then actually a liability of the banks. Here the banks pay interest to the investor. Mortgage rates, mortgages are liabilities of households. If you buy a house, maybe you actually get a mortgage on the house, and then you are able to pay for it. So those are all credit contracts. If you like all those credit contracts, you may call them bonds. Even a mortgage. With a mortgage, you sign a piece of paper. That's a mortgage, and that's a credit contract. It's very much like a bond. You have to pay interest on it, and then actually maybe after 20 years, so mortgage expires. Okay, you make the last interest payment. Okay, that's private credit markets. Now, the prime rate is the interest rate that the most secure borrowers pay in the United States. It's called the prime rate. It's a term that you quite often see in the newspapers. Now, down here in item 3, we have official interest rates. Here is the interest rates which are set by the government, not in the private credit market, by the government. It's called the discount rate. The central bank can set the discount rate. In some countries, it's called the bank rate. In South Africa, it's called the SARB repo rate. That's the interest rate which central bank charges to private banks when private banks borrow money from the central bank. So those are government rates. They are set by the government. Now, why is it called the South African Reserve Bank repo rate? We have to now discuss what is a repurchase agreement. A repo is a repurchase agreement, and the South African Reserve Bank sets the interest rate on those repurchase agreements. So when a bank needs cash, it may sell securities to the Reserve Bank with an agreement to buy those securities back at a slightly higher price, maybe in 1 week or in 1 day. It's also very short term. So the private bank takes some securities. Only some securities are eligible. So it cannot take all securities. Okay, it must be an eligible securities. There are certain requirements here. So it takes those eligible securities, it sells them to the Reserve Bank maybe for a price of 100, and makes an agreement to buy them back on the next day for a little bit more than 100. So actually, the bank then has the cash for 1 day because it has sold those securities. It can use the cash for 1 day, and it pays interest because it has to pay back a little bit more the next day. So maturities go from 1 day to about 1 week. So distinguish between the SABOR and the SARB rate, the SARB repo rate. SABOR is actually the interbank rate between private banks, the private credit market for a 1-day loan, the South African benchmark overnight rate. That's SABOR. The SARB repo rate, that's the repurchase rate. Okay, when a bank borrows from the Reserve Bank. That's an official rate, okay, for a 1-day loan or maybe a loan for 1 week when a private bank borrows money from the Reserve Bank. Usually, when a bank needs cash, it goes to the other bank, it goes just to the interbank market and borrows money in the interbank market and pays then the SABOR rate to the other bank. But during financial crisis, you may have actually a run for liquidity. All the banks would like to borrow during the financial crisis. And so it's no longer possible for a bank to go to another bank to borrow because all the banks want to borrow. And then the Reserve Bank acts as a lender of a last resort. So in 2007, 2008, during the global financial crisis, the interbank credit market collapsed, it froze. And so then actually the banks went to the Reserve Bank and borrowed the money from the Reserve Bank. That's an important function of the Reserve Bank, to provide money during financial crisis. Now this brings us to another security, to another financial instrument, shares. Shares represent the interest of owners of the firm. We also call it equity. We speak about the equity. Now that's not a credit contract. So you are really here the owner of the firm. Maybe a firm issues 1,000 shares. So if you buy a share, you own a small part of the firm. You own 1/1000th of the firm. And you get a return on it if the firm makes a profit. So that then is called the dividend on the share. The annual general meeting then decides on how large the dividend should be. If there is no profit, okay, there is no dividend. So it's not the credit contract here. You are the owner of the firm and you get money if there is a profit. Now shares look very similar to bonds, with a certificate and a coupon sheet for the dividends. But also today, the shares are electronically recorded. So shares also looked like a bond. You had here a certificate, you had the coupon. Each year, as shareholder, you cut off the coupons, but you did not get a fixed interest payment. You got the dividend, and the dividend could be different from year to year, depending on what the profit of the firm is. So with shares, you are actually owning a part of the firm. It's not the credit contract. Okay, that finishes it for today. Thank you.